Okay, we're back. This is going to be chapter number 5. We're going to take a look at two problems. The first problem is going to deal with journal entries. Chapter 5 deals with merchandising, that is, buying and selling inventory, or sometimes called goods, or sometimes called merchandise. Yes, you're right. I did get a haircut. That's true. But let's take a look. We're going to start off with the first problem. And this is the in-class journal entries for merchandising company. And we have the Nancy company here. And we are going to take a look at the entries for buying goods on the 3rd, on the 4th, and on the 11th. So this is what happens. On the 3rd, we happen to be buying $20,000 of inventory on account. Inventory is an asset, so we debit inventory, the asset, and we credit the accounts payable for $20,000. Now, on the handout, I want you to look at the end of the first transaction on the 3rd, and it says that the credit terms are 2/10, N/30, FOB destination. Right, what that means is the 2/10, N/30, those are the credit terms. And the 2/10 says that you will get 2% off if you pay within 10 days of the invoice date. And we'll assume the invoice date is the 3rd. So if you pay within the 10 days, you will get 2% off. If you don't pay within those 10 days, you have to pay the total amount in 30 days. Now the next part, the FOB, FOB is a legal term, and it stands for free on board. That is, the goods are free on board to, in this case, the destination. Since we are the buyer, free on board says that they're free on board to our place. Being the buyer, that means we don't pay for the goods, the transportation of the goods separately. The transportation is in the $20,000. So, the first entry, as we've said, debit the inventory, credit the accounts payable. The second transaction we see, looking at the handout, we return $1,500 of goods. So since we've returned them, we no longer owe the $1,500 of the payable. Payable was $20,000. We're going to reduce that by 15. So we debit the payable by $1,500. You know what? If we return them, we don't have the inventory anymore, so inventory is an asset, and we credit the inventory $1,500. That's the second transaction. Now, the third transaction says we're going to pay for the goods purchased on the 3rd. All right, now let's think back. We originally said we owed $20,000, but we returned $1,500. So at present, we owe $18,500. The 20 less the 15 gives you $18,500. We're going to pay these on the 11th. Now, that's within the 10 days. Therefore, we're going to get 2% off. Do you take 2% times the original price of $20,000? Or do you take 2% times the amount that is now due, the $18,500? Well, you can see from my journal entry right here, it is going to be 2% is the discount that we're going to take of the $18,500, the amount presently due. So we don't pay $18,500, we pay $18,500 less the discount of $370. So the journal entry decreased the payable by $18,500. The cash amount is going to be the $18,500 less the $370, the discount. $18,130 is the amount of the cash that we're going to pay. So we credit cash that amount. And the inventory then goes down by $370. Now, why does the inventory go down? Because we didn't pay $18,500. We reduce it by the cash discount or the discount for early payment. Now, how does all of this fit into the T accounts? Well, let's just go over here to the board, and I've got those T accounts here. You'll see the cash, we paid $18,130. and that was the amount that we happened to pay. The accounts payable started off at 20. It was reduced by the $1,500 for the amount that we've returned, and it has $18,500. Now, you recall on the entry of the 11th, we happen to have debited that account, which got us down to a zero amount due because we paid it off. And the inventory account up here, we originally had $20,000 that we charged. We returned 15, so that caused inventory to go down. And we had the cash discount, and that discount reduces the inventory because we're only paying $18,130. So please note that what we paid for is what the inventory shows up at, $18,130. Now, the next entry that we're going to look at is we're going to start selling some of this inventory. So we'll come back in just a second and I'll show you the journal entries of how to sell the inventory and how to book those sales. Okay, we're back. We're going to start off and we're going to take a look at the 15th of January. And we're going to sell 30% of the inventory that we just bought. So if you take a look at the inventory we have, $18,130, we're going to sell 30% of that. That cost is $5,439. And we're going to sell that. But we don't sell it for what it cost us. If we do, we're not going to be in business very long. We're going to sell this inventory for $8,000. Now, if you recall, there are two types of inventory systems. There is a perpetual system and a periodic system. We're going to be using the perpetual system. What that says is every time we buy inventory, we debit inventory. Every time we sell inventory, we're going to have to credit the inventory account. But inventory is at cost. We sell it at a markup price. So what that means is that we're going to have two journal entries every time we sell goods. And those two entries are, as we see right here. We're going to have the accounts receivable debited, or if we got cash, we would debit cash, but in this case we happen to have somebody buying on account, and we are going to credit sales for the sales price of $18,000. But we have to account for the inventory leaving our operation. So we debit a new account. That account is a temporary account called cost of goods sold. That's an expense account. It doesn't say expense at the end, but we all need to know cost of goods sold is an expense. And we debit that expense account for the cost of the inventory, which was $5,439. We sold it for $8. The difference between $8 and the $5,439, that's our profit. And then we have to credit the inventory for the cost of the item. So the inventory account now has just gone down because we don't have that inventory anymore. Now, on the 15th, if you look at the whole question here, the transaction, it says sell 30% of the inventory for $8,000. Credit terms. That means we gave the buyer some credit terms. Those terms were 1/10, meaning they get to take 1% off if they pay us within 10 days. But we want the total amount due in 60, N/60. In addition, it says FOB destination. All right, we are the seller. If it says FOB destination, what that means is that we, the seller, will ship the goods all the way to the destination place. So we, the seller, then have to pay the freight, and that's the next transaction. That transaction is on the 16th, and it says freight cost on the transportation of goods on the 15th amount to $550. That journal entry, we debit delivery expense, because that's a cost for us to get the goods out to the consumer. $550. And we credit cash because we're paying for that. Now, if these goods had been sold, not FOB destination, but FOB shipment point, we're telling the buyer that we, the seller, will pay them to the shipment point. Well, the shipment point is our warehouse. So in essence, we don't incur any costs of shipment, but the buyer would incur those costs. So we need to know FOB shipment point, FOB destination. We need to know the credit terms. In this case, 1/10. We're going to give the buyer 1% off if they pay within 10 days. And you'll notice here on the 18th, the customer that purchased the goods is going to return those to us. And when we get back, I'm going to show you the journal entry for that. Okay, we are back, and let's take a look at the transaction on the 18th. The customer that purchased the goods on January 15th returned $2,000 of the goods that cost us $1,360. Now, if you recall, looking up at the 15th of January, we sold them $8,000. That was the sales price. And those goods had cost us $5,439. So they're returning 2,000 of those. And those goods cost us $1,360. So what we do is we debit a new account, we haven't had it before, sales returns and allowances for the sales price of $2,000. And we credit accounts receivable for $2,000. They don't owe us that anymore, so we decrease that asset, accounts receivable. Now, sales returns and allowances, that happens to be a contra account. That means it has a contra or an opposite balance to the normal balance for sales. Sales has a normal credit balance, so sales returns and allowances has a debit balance. Now, some of you might ask the question, why don't we just debit sales? Well, we don't debit sales because we want to keep track of what the cost, or the sales price, I should say, of the goods we've sold to the customer, how much of that is being returned to us based on our return policies, because it's very expensive to allow the customer to return goods to us. And therefore, we want a separate account. If we didn't have a separate account for sales returns and allowances, it would be buried in with the sales transactions. It'd be a little more difficult to take a look and analyze how much of our goods are being returned that we're selling. So we have a new account, sales returns allowances, and that is a contra sales account. Got a debit balance. In conjunction with the transaction to reverse the sales, we must go and reverse and show that we have received the goods back. Those goods that we sold are now coming back into our inventory. So we've got to debit the inventory, and we've got to take out or reduce this expense. This was a new account in this chapter called cost of goods sold. And that is for the cost of the item. So again, in this transaction, we sold the goods for $8,000, but these goods were the $2,000 portion, and they had a cost of $1,360. All right, we're going to go and we're going to come right back. We're going to take a look at the last three transactions of this particular problem. Okay, we are back. We're taking a look at the transaction on the 19th, and we see from the facts that we're going to sell some inventory. It's costing us $3,000, and we're going to sell it to the customer for $4,000. So the sales price is $4,000. Those goods cost us $3,000. We notice that there are no credit terms, and it's FOB shipment point. So the journal entry here on the 19th, we're going to record the sale, and this time instead of the buyer telling us that they're going to pay us later, they're paying us right now. We debit cash because they're giving us the cash. We're going to credit sales for $4,000. Now, these goods cost us $3,000. So what we're doing is we have that expense account, cost of goods sold, for the cost of the goods, $3,000, and we're going to reduce the inventory, because we're using the perpetual inventory system, by $3,000. By all accounts, at the present time, it would appear that what we have made on this transaction, we sold goods that cost us $3,000, we sold it for $4,000, we have a gross profit of $1,000. Let's go down to the 20th. Now, I don't have anything written in here, and let's see why that is. It says on the 20th, the freight cost on the transportation of the goods sold on January 19th amounted to $400. But let's go back up and look at that transaction on the 19th. It happens to say, right at the end of that sentence, that these were FOB shipment point. That means free on board to the shipment point. Well, our place of business is the shipment point. Therefore, we're telling the customer, hey, we will get them ready. You need to pay for the transportation. This is the books of the seller, not the buyer. So in reality, that information on the 20th that I've given you is not relevant to what we're doing here. That is irrelevant to the buyer's books, not the seller's. Now, I will give you a little bit of a hint. On quizzes and on exams, often I will put that information in there. And you have to look and you have to ask yourself, whose books am I recording these transactions? And is this something that should be recorded on my books? If I'm not responsible for the $400, you may have that information, but it's not going to go in your books and records. Now, the last transaction here on the 30th, let's take a look. It says the customer that purchased goods on the 15th pays for the product. So I got to go all the way back up there to the 15th. And that is where we sold 30% of our inventory, and we sold that for $8,000. Now, that customer, if you recall, on the 18th, returned $2,000 of that. So although I've got $8,000 here, it really isn't $8,000, is it? Because they originally bought it for $8,000 and they returned $2,000 of that. That reduced the amount that they owed us to $6,000. The terms of that happen to be, and I need to go back up to the 15th, if they paid within 10 days, the credit terms were 1/10. If they paid within 10 days, they got 1% off. That invoice was the 15th. So we add 10 days to that, and then we see when they paid it. Well, they paid it on the 30th. Are they within the 10 days? No. Actually, it took them 15 days. So how much do they owe us? They owe us the outstanding balance that's due. They owe us $6,000. So, yes, I know I had $8,000 here. That's not the amount. That was to get you to think that it's not the 8, it's really they owe us 6. And so we would put, we're going to get $6,000 cash, and our receivable is on our books at $6,000. We're going to credit that for $6,000. All right, so that is the problem dealing with journal entries. There are two things in this chapter that you must be able to do. Number one are journal entries, and these are the journal entries you need to do. Number two are going to be some calculations, and that's the next problem we're going to take a look at.